I have been journaling my trades every single day for 3 years. Every futures position, every entry, every exit, and every mistake. And this is the exact strategy I built from that data. I'm going to walk you through my complete trading framework, how I read the market, how I build my bias, and how I find entries in the futures market. Whether you want to scalp intraday like I do, or you prefer to swing trade around your schedule, this system works for both, and I'm gonna show you why. Most people who try to trade futures don't fail because the market is too hard. They fail because they don't have a framework. They have a strategy, and those two things are not the same. A strategy tells you what to do, but a framework tells you why. And most importantly, when not to. When you only have the why, the first time, for example, NQ doesn't behave the way you are expecting, you are lost. You start adjusting mid-trade, you start revenge trading, and you start looking for a new setup when the old one was just fine. What I'm about to walk you through isn't a set of rules. It's a way of reading price that I tested over 1,000 trades in the futures market. Everything starts with one principle. Markets move from swing point to swing point. That's it. That's the foundation. When I open a chart, doesn't matter if it's NQ, ES, or anything else, I'm asking one question first. Where has price come from and where is it likely going to? That's my bias, and bias only comes from the higher time frames. For me, that's minimum the 1 hour, and it can go all the way up to the weekly. But honestly, that's up to you. It really depends on the time frames you like to work with. So I start here on the daily. I identify the directional bias. Is price in a bullish run, meaning candles are closing above previous day high, or is it bearish, meaning candles are closing below previous day low? Is there liquidity sitting below that the market is likely to sweep before it moves higher, or is there a fair value gap that needs to be retested first? Once I have that picture, I drop to the middle time frame. The middle time frame, in this case the 1 hour, tells me the chapter I'm in. Is the structure aligned with my bias? Is price approaching an external range liquidity or an internal range liquidity? And then, only then, I go to the lower time frame and look for the entry. So, on the higher time frame, I look for my bias. On the middle time frame, I look for my structure that is aligned with the bias. And on the lower time frame, I look for the entry. That's the whole system. Every concept I'm about to cover sits inside these 3 layers. So, I have my bias from the higher time frame. I know the direction price is likely to move. But knowing the direction isn't enough. I need to know where price is likely to react. And that's what a point of interest is. A point of interest is a specific zone on the charts where the market has left a footprint, where institutional activity happened, where liquidity is sitting, where price has a reason to do something. I don't trade random levels, I wait for these zones. The main ones I use are 3. First, fair value gaps. It happens when price moves so fast it leaves an imbalance in the order flow. You will see it as a 3-candle formation where the middle candle moves so aggressively that the wicks of the first one and the third one, they don't overlap. So in this case, price tends to come back, fill the gap, and then continue higher. And the same goes for the bearish side. You will likely see price retesting the fair value gap and then keep moving lower. Second, the external range liquidity. These are obvious levels where retail stop losses build up, below swing lows and above swing highs. Usually price grabs that liquidity before making its real move. And when I see an external range liquidity aligned with my bias, that's a zone I'm watching closely, I'm interested in. So if my bias is bullish, I'm gonna wait for price to grab this liquidity before moving higher. And if my bias is bearish, I'm gonna wait for price to grab this liquidity and then move lower. Third, SMT divergences. This one is specific to correlated instruments, NQ and ES for example. An SMT is when one sweeps a key level and the other does not follow. So we can see that one of them is lying. And this divergence tells you which direction the real move is coming from. Now, knowing the zone is not enough on its own. I need a confirmation that price is actually rejecting from it and that the reversal is real. And that confirmation comes from the swing formation. A swing formation is a specific sequence of candles that tells me a reversal is happening. It's not just a wick, it's not just noise, it's an actual turn in price. This is what I look for every single time I trade. There are two versions. The first, candle 2 sweeps the high of candle 1 and closes back below it. That's the confirmation. And from there, we look to trade the continuation on candle 3. The same logic applies for the bullish setup, it's just flipped. So candle 2 sweeps candle 1 low and closes above. In this case, we can trade candle 3 continuation. In this second version, candle 2 does not sweep candles 1 low. Instead, it just closes below. In this case, candle 3 is not tradable yet. But if candle 3 closes above candle 2, then we can look to trade candle 4 continuation. And again, the same applies for the bearish side. So candle 2 closes above candle 1, candle 3 is not tradable, but then we see candle 3 closing below candle 2, so we can assume that candle 4 is gonna keep moving in that direction. I do not take a trade unless three conditions are met. I call them A, B, and C. Condition A. In this case, we are on the daily on NQ, and we can see that candles are closing above previous day high. So it's a clear bullish bias. Condition B, the middle time frame. In this case, we are on the 30 minutes on NQ, and this time frame needs to confirm the narrative. I'm looking for a point of interest and a swing point that aligns with my bias. In this case, we have the fair value gap, which acts like a point of interest, and we have the swing point. We see candle 2 sweeping candle 1 low and closing above. So in this case, we can trade candle 3 continuation. Condition C. On the lower time frame, in this case the 3 minutes on NQ, I am looking for a CIST, a change in the state of delivery, which is confirming the move. A CIST is basically a candle that confirms that price has shifted direction, and that's my green light. Now, I wait for candle 3 to open because, as we said before, we have candle 1, candle 2, and we can trade candle 3. So I'm gonna wait for candle 3 to open, and I'm gonna get in on the next propulsion block, which is basically another internal CIST, a change in the state of delivery again. And that's where I want to get in. Without A or without B, I don't even look for C. And that's the discipline that separates the trades that work from the ones that looked like they should have worked. When all three are aligned, well, that's the trade. One entry, clean stop at the lows, it might be here or here, and a clear target. And that's it. Everything else is noise. If I have A, B, and C, that's my trade, that's my entry. I want to be clear about something because I know not everyone watching this can sit in front of the charts from open to close. This framework works on every time frame. If you are trading full-time, intraday, scalping, or catching moves on the 1 minute or 3 minutes during the New York session like I do, well, it works. If you have a job, a life, a family, and you can only check charts in the evening or manage trades once or twice a day, you can run the same system on the 4 hours, the daily, or any higher time frame. The logic doesn't change. Bias, structure, entry. Those principles don't care what time frame they are on. So let me bring it back. Higher time frame for bias, middle time frame for structure, and lower time frame for entries. A point of interest, an FVG, ERL, or SMT where a market has a reason to react. Risk managed like this account is the only one you'll ever have. That's the Sierra Trades framework. It's not complicated, but it took 3 years of journaling every single day in the futures market to trust it. If this gave you a clear picture of what a real structured approach looks like, well, that's exactly what I wanted from this video. There's a lot more behind every concept I covered today, and we're gonna walk through all of it together. The formations, the zones, and the full execution. So make sure to hit subscribe, turn your notifications on, you don't wanna miss what's coming next.